Hello, and welcome to the launch of the International Energy Agency's new special report on the oil and gas industry in net zero transitions. I'm Jethro Mullen, head of the IEA's communications team, and I'm joined today by IEA Executive Director, Dr. Fatih Birol, and by the lead authors of the new report, our Chief Energy Economist, Tim Gould, and the head of our Energy Supply Unit, Dr. Christoph McGlade. During today's event, Dr. Birol will make some opening remarks, and then Mr. Gould and Dr. McGlade will present the key findings of the report. We'll then take questions from journalists. For the journalists taking part in this press webinar, we invite you to send your questions via the Q&A function in the Zoom. You can do this at any point during the presentation, and we'll also take a 2-minute break right after the presentation for you to enter your questions. And with that, I'll pass the floor to our Executive Director, Dr. Birol.
Thank you very much, Jethro, and greetings to all the colleagues from the IEA headquarters in Paris. Today we are in front of you to launch our report on the oil and gas industry in net zero transitions. We would like to have a productive discussion on this crucial topic, and we believe this topic requires a solid evidence-based discussion and a dispassionate analysis, and it is what we hope to provide with this report. I would like to thank, just before starting my remarks, my colleagues, Mr. Tim Gould and Christoph McGlade, and their colleagues very, very much for this extremely important report. Some of you may remember that last year, before the COP27 in Sharm el-Sheikh, we came up with a report on coal, the coal in net zero transition. This year, we are coming with this very report. Now, this report comes exactly a few days before the COP28 in Dubai. We are at the IEA discussing with the oil and gas industry, with the leaders, with the ministers from the oil and gas producing countries. And we made this report with the hope that it will provide some input for the considerations of the oil and gas industry leaders. But from our point of view, dear colleagues, based on all the discussions we have been going through in the last few months and if not years, COP28 will be a moment of truth for the oil and gas industry. It will show whether oil and gas industry will be the partners of the fight against climate change or not. So simple in our view. And this report is, of course, we just published only a few days before COP28, but when you have the chance to go to the report, you will see that it can well serve as a reference for the world to review the steps oil and gas industry will take or not. So when we look at the situation today, the oil and gas industry and the clean energy and our climate challenge, the starting point is not very encouraging. At least we think so. Just give you one criteria what we think. It is not a very encouraging start. This year, all the clean energy investments in the world, all of them put together, is about 1.8 trillion US dollars. And the source of financing comes from governments, from industry, from investors, in many, many different places. And the share of oil and gas industry in the global clean energy investment is less than 1%, just to put the things in a context. And this is, therefore, we believe it is important to put the numbers on the table vis-a-vis what we are hearing from the leaders of the oil and gas industry in terms of their position on the issue of climate change. So what could be from the IEA perspective of the oil and gas industry's response to the climate crisis. And we hope that this will be documented and confirmed by the oil and gas industry leaders in a few days in COP28, where it takes place in the Middle East, a major oil and gas producing region. So, what are the answers that the oil and gas industry can give? And we have, in fact, two areas we would like to highlight what the answers could be, and they are all, as we do at the IEA, based on numbers. One of them is we hope to see that the oil and gas industry, first of all, reduce the emissions from its own operations. When the oil and gas industry gets the oil and gas out of the ground, process it and delivers to the consumers, during these operations, a lot of emissions go to atmosphere, both carbon dioxide, methane, and the others. And these emissions put together account about 15% of the global emissions. It's because the emissions, total emissions of United States today. And those emissions, including the methane emissions, we know that they can be fixed rather easily, quickly, and in many cases in a cost-effective manner. So therefore, our first suggestion to the oil and gas industry is commit yourself in Dubai to reduce your own emissions from your own operations by 60% by 2030, which would put them in line, their own emissions from own operations in line with the Paris goals. So this is the first one, and I think this would give, if they commit to that, this would give an entry ticket to be part of the genuine partner in our fight against climate change. But I see that there is another role we believe that part of the answer of the oil and gas industry would be that those industries embrace the clean energy economy emerging. So this is the second answer we suggest. What is that? When we look at today in a clean energy world, there are technologies which overlap with the experience, with the skills of the oil and gas industry, what they have been doing years and years, such as offshore wind, such as hydrogen, such as biofuels, biomethane, carbon capture and storage in some areas, EV charging. So these are areas that the oil and gas industry can make major efforts, especially in terms of their investments. So what my colleagues did, I think it was a heroic work, a lot of data mining. They have found out how much today of the total capital expenditure of the oil and gas industry goes to clean energy options. And the number is rather disappointing. Today, only 2.5%, only 2.5% of the total capital expenditure of oil and gas industry goes to clean energy. In my view, dear colleagues, this 2.5% contradicts significantly this share, this modest share, with the share of clean energy statements coming from oil and gas industry. And therefore, we suggest, again in our report, that if the oil and gas industry wants to be a real, genuine partner to address the climate change, climate crisis. It's a problem of all of us. We think this 2.5% by 2030 reaches about 50%, 50% as an aspirational target for the oil and gas industry. So these, from our point of view, these are two answers, two areas that the oil and gas industry executives, the government leaders of oil and gas producing countries may think and may take some action. Before finishing my words, I mentioned what the answers would be, and if I may, I want to mention what is not the answer. Now, today we see that some people say there is no contradiction between oil and gas trends continue as they are, and at the same time we can bring down emissions in line with our climate targets. They say the solution is carbon capture and storage technology. So, from our point of view, carbon capture and storage is an important technology, and it can well play an important role in certain applications, certain sectors, such as cement, such as iron, steel, and others. But to say that the carbon capture and storage technology would allow the oil and gas industry continue with the current oil and gas production trends, and at the same time bring the emissions down in line with Paris target is, in our view, is a pure fantasy. We have calculated that in order to reduce the emissions, capture the emissions from the current oil and gas production trends in the future, and bring it to emissions in line with our climate targets, through CCUS would require a significant amount of annual investments. It is about annual investment for CCUS in that case would be about 3.5 trillion US dollars. 3.5 trillion US dollars. If you want to know, today, this year, which is a good year for CCUS investment, this year the CCUS investments were about 4 billion. So we are talking about an increase of investment CCUS, a factor of almost 1,000. 1,000. So this compares when we say the renewable capacity needs to increase by 3 times, efficiency by 2 times. Many people thought they were really not realistic numbers. But here, we are talking about the increase by a factor of 1,000 in order to make oil and gas production compatible with our climate targets. So this is just I wanted to mention to you. But again, we are at the IEA, we believe that the clean energy progress will continue with or without oil and gas producers. We hope it is together with oil and gas producers, but it will go even without them. It will be bumpier, the road, and maybe a bit more costlier, but it will still continue because clean energy progress is unstoppable when you look at the numbers. We believe this special report shows a fair and feasible way to oil and gas industry to be real partners of the entire world to address our climate challenge. I would like to once again thank my colleagues Tim Gould and Christoph McLeod and their teams, and I am now going to give the floor to Mr. Tim Gould, our Chief Energy Economist, to take us through some of the very interesting and key findings of our report.
Well, thank you very much indeed, Executive Director. We've mentioned already the oil and gas industry, so what I would like to do is first to say a few words about what that industry is and what it looks like, because certainly when we consider oil and gas companies, we might have different things in mind when we consider what they are and what they do. For many, the first thing that people think of is maybe one of the international majors, 7 large, mostly integrated oil and gas players that we hear about a lot in the news. But as you can see on the screen, they're only one part of that picture. And indeed, they're not even the largest part. They account for less than 13% of global oil and gas production, but also of reserves. Much bigger contribution comes from national oil companies around the world. More than half of global output and well over half of global reserves as well. And they can be national oil companies that have a domestic focus, or they can be internationally focused. And if we look at break that picture down into the actual composition of the oil and gas industry, you can see that in some cases those national oil companies are considerably larger in size than the majors. And there are even some elements of the oil and gas industry that are not represented here on the production side: traders, refiners, oil and gas service companies as well. This is an industry that produces around half of global energy supply. And it's indeed an industry that's responsible through its operations and its products for around half of global energy emissions. And company circumstances and capabilities are different. This is a diverse industry, and we'll get into some of that diversity in this presentation, and there's a lot more in the report itself. But one thing that applies across the board is that the sorts of changes that we see coming in the global energy sector are affecting all parts of the industry. So all elements of the industry will need to consider how to respond. We should also remember that the oil and gas industry is central to some very large flows of money, of revenues around the world. And we've had some large swings in recent years with the COVID pandemic and with the global energy crisis in the last couple of years. But since 2018, if we look at average amounts, the industry has generated around $3.5 trillion in revenue on average every year. Where does this money go? Around half went to governments, where it helps to fund a range of government services. And in some producer economies, I mean, Iraq is a good example, that is really the overwhelming source of government revenue, very substantial share in overall government revenue, well above 90% in some cases. A share, you can see, went back to shareholders via dividends, share buybacks, and net repayment of debt. And there's also this revenue funds oil and gas company investment, and the lion's share of this goes back into traditional areas of supply. I'd like to draw your attention to a small green square on the bottom right-hand corner of the screen. That is the amount that currently goes back into clean energy investment. And the sorts of transitions that we'll be talking about today introduce strong pressure on these revenue streams. And that's going to have profound implications, not only for the industry, but also for governments, shareholders, and financial actors. Many of you may remember that a few weeks ago, we launched the new IEA World Energy Outlook. And in that report, we analyzed the momentum behind today's clean energy deployment and concluded that that momentum is strong enough to bring about peaks in demand for all of the fossil fuels, for coal, for oil, and for natural gas. But as you can see on the screen, the declines on the other side of that peak, if we look at today's policy settings, are relatively shallow. And that does lead us into very dangerous territory from a climate perspective. We are at 1.2 degrees Celsius of warming above pre-industrial levels on average around the world already, and we're seeing the impacts of that. That stated policy scenario would be consistent with another 1.2 degrees of warming by the end of the century to get us to 2.4 degrees Celsius above pre-industrial levels. So the question that the executive director just posed, and the question we ask in this report, is will the oil and gas industry be partners in moving beyond that outcome, in moving us towards scenarios that are consistent with national energy and climate goals, as in the announced pledges scenario, or with a 1.5 degree stabilization in global average temperatures, as we analyze in our net zero emissions by 2050 scenario. And you see here the sorts of changes that would be required to move us beyond that outcome, the direction of travel we are on today. Electrification, in the case of bringing down oil demand, is an absolutely key technology. So by 2050, in the net zero emissions by 2050 scenario, 95% of the cars on the road are electric. But there are also areas like low emissions fuels, biofuels, ammonia, hydrogen in some cases, that help move us in that direction. And the picture is then a similar one for natural gas. You reach a high point in the stated policy scenario towards the end of this decade, but then there's a flattening, and it's a question then about the industry engagement in moving us beyond that kind of outcome towards the sorts of outcomes that we have in the other scenarios that meet net zero transition goals. And some expect gas to play a more durable role in transitions because it produces fewer emissions than oil or coal. And that's certainly true in some sectors, in some countries, in some timeframes, particularly among some developing economies. But net zero transitions ultimately mean tackling all sources of emissions, including those from natural gas. And the sorts of changes that then bring down natural gas demand, renewables in the power sector, electrification of heat, efficiency improvements across the board, but also some molecules in there, low emissions gases, biomethane we think has important potential, and of course in there as well are gases like low emission hydrogen. And this has implications then for the supply side, for the investments that we need. And on that, I pass the floor across to my colleague, Christoph.
Thank you very much, Tim. As Tim just mentioned, we don't have zero oil and gas demand in 2050, even in a scenario that limits the temperature rise to 1.5 degrees. And this means that investment in oil and gas supply also doesn't need to drop to zero. In fact, as we can see, if all investment were to stop in oil and gas supply, the declines we would see in supply would exceed the declines even in a 1.5 degrees world. But the levels of oil and gas investment that are needed are far lower than what we see today. This year, we will see around $800 billion invested into oil and gas, and this is double what's required in 2030 on a pathway that limits warming to 1.5 degrees. And this is because the declines in demand that we see mean that we do not need any new long lead time upstream oil and gas projects from today. A large number of projects have been approved in recent years since Russia's invasion of Ukraine and other developments. But that means that because demand declines so sharply, some existing sources of production would need to be shut in. In 2040, for example, more than 7 million barrels per day of oil production is pushed out of operation before the end of its technical lifetime. And we often hear producers arguing that it should be them that produced the last remaining volumes of oil and gas in 2050. Some make the case that they have the lowest production costs. Others claim they're a better option for energy security. Some highlight that they have the lowest emissions intensities. Others that oil and gas developments are needed to improve welfare. And there's a large number of reasons that producers can make on why they should be the last one standing. But they can't all be right in a net zero world. In the demand environment of the net zero scenario, any new oil and gas resource developments need to be matched by reductions elsewhere if we are to avoid oversupply. So companies and countries looking to undertake new resource developments need to explain carefully how their plans are viable within a 1.5 degree pathway and be transparent about how they plan to avoid pushing this goal out of reach. If we look on the supply side at our other scenarios, in the announced pledges scenario, the declines in demand are not so sharp and new project developments are needed. However, in this scenario, it's possible to bring on enough new supply with the oil and gas volumes that have already been discovered. So in other words, if countries achieve the net zero targets that they have set themselves, then in aggregate, there's no need for further oil and gas exploration. In the stated policy scenario, despite that peak in oil and gas demand before 2030, investment in new and existing sources of supply is essential. So how should the industry respond to these different futures? There's one element that must be in every single company transition strategy, no matter what the future, and that's reducing emissions from their own operations. As we heard from the executive director, extracting, transporting, processing oil and gas today results in around 15% of global energy emissions. And to align with the 1.5 degrees scenario, these emissions need to be cut by 60% by 2030, and soon after 2040, the emissions intensity of oil and gas operations would be very close to zero. These reductions need to be achieved without any use of offsets or carbon credits, and tackling methane emissions must be the top priority. But methane's not the only thing that needs to be done. Reducing flaring, electrifying facilities, using low emissions hydrogen, and CCS are all key. Those reductions in emissions are a necessary step for oil and gas producers to be taken seriously in climate discussions, but there's more that they need to do. They also need to embrace the clean energy economy. Clean energy investment by oil and gas companies has certainly been growing in recent years. Last year it invested about $20 billion, double the level of 2021. But we should put this into context. To date, the engagement by the oil and gas industry in clean energy has been minimal. Only 1% of all of the clean energy investment today comes from oil and gas companies. The industry can play a much greater role in this, and there's many opportunities that lie ahead. If we look at the final energy that is used today by consumers, around 3/4 comes from fuels and around 20% is from electricity. In our net zero scenario, electricity is set to take a much greater share, growing to about half of that final energy consumption in 2050. But fuels don't disappear. And we estimate that in 2050, about 30% of the energy consumed in 2050 in a 1.5 degree world would come from clean technologies that could benefit from the skills and resources of the oil and gas industry. Hydrogen, carbon capture and storage, offshore wind, biofuels, biomethane, and many others. These are technologies that could benefit from the inputs of the industry, from its knowledge on how to handle large volumes of oil and gas, of liquids and gases, the technical and operational expertise that it has, and the experience it has in developing and managing multi-billion-dollar projects. And we estimate that in total, around about 2.5% of the capital spent by the industry today goes towards clean energy, and that could rise to 50% if the industry gets on track with 1.5. Of course, it's not automatic that oil and gas companies must invest in clean energy. Some companies may decide that their expertise and advantages exist only in oil and gas, but if they might make that decision and they want to align with climate targets, this means winding down traditional operations over time. The uncomfortable truth is that net zero transitions mean lower demand for oil and gas, and that means scaling back on oil and gas operations. And I'd like to finish with a few words on producer economies, those countries Tim mentioned that rely heavily on oil and gas sales for their national budgets. The prospect of falling oil and gas demand adds a new dimension to the need for these countries to diversify their economies. If we look at a selection of the 10 of the largest established producer economies, we see going forwards their populations expanding considerably over the period to 2050, yet income from oil and gas would fall by around about 70% in our announced pledges scenario and by as much as 90% in our net zero scenario. This would create a powerful incentive to accelerate the pace of reform in these countries while also draining a source of revenue that could finance it. But there's two important things to note here. First, today's producer economies retain some advantages even as the world moves away from fossil fuels. They have ample, underutilized renewable energy resources, and they could leverage these to create new low emissions industries and new positions in clean energy supply chains. And secondly, successful transitions are collaborative ones. It's incumbent on consuming countries to work with producing economies to help them achieve the changes that are necessary. For example, consuming countries must send clear and unambiguous signals on the direction and the speed of a transition so that producers can make informed decisions on their future spending levels. We sometimes hear that transitions can only be led by changes in demand. Some argue that when the energy world changes, so will we. This is not an adequate response to the immense challenges that are at hand. But we also can't just focus on reducing fossil fuel supply. This would come with a heightened risk of price spikes and market volatility. What's clear is that dialogue across all parts of the oil and gas value chains are essential to deliver an orderly shift away from fossil fuels. As the Executive Director mentioned, the net zero transition can for sure happen without the engagement of the oil and gas industry, but that journey would be much more costly and much more difficult to navigate if they're not on board. Thank you very much.
Thank you, Christoph, for the presentation, and of course to Tim Gould. So we now have time to take some questions from journalists. We invite the journalists in attendance to send your questions through the Q&A function of the Zoom if you haven't done so already. And please mention your media outlet along with your question. So we'll now just take a 2-minute break to give you a chance to enter your questions, and we'll be right back. Hi everyone, welcome back. So we're getting a lot of questions, which is excellent. We'll try and cover as many of them as we can. We're going to start with some questions around the investment issue. So one question is, has this new report led you to rethink the finding from your net zero roadmap that no new investment in oil and gas supply is needed in reaching 1.5 Celsius? And on that note, Nathalie Alonso from Agence France Presse asks, what do you think of the fact that companies have continued to approve projects with final investment decisions despite your recommendation of no new oil and gas projects back in 2021 when the first net zero roadmap was published? I think Christophe McGlade is going to take those questions. Over to you, Christophe.
Thank you very much, Jethro, and thank you for the questions. When we released the net zero roadmap in 2021, one of the key findings from that report was that with a huge surge in clean energy investment, this would bring about a decline in fossil fuel demand. And that decline in fossil fuel demand was sufficiently sharp that we didn't require investment into new oil and gas fields. Since that report was released, a lot has happened. One of the big events on the supply side, of course, was Russia's invasion of Ukraine. And we now expect that large volumes of gas from Russia will become stranded and won't be able to find markets. But in addition to that event, we have also seen companies approving a large number of fields, new projects around the world. We, of course, update our scenarios every year. This is essential to make sure that our scenarios are grounded in real-world conditions and make sure that we are always reflecting the latest developments in the world. What this means, this level of new approvals is such that with the declines we see in fossil fuel demand, we are now in a situation where in the 2040s, we have more oil and gas that is needed on the supply side compared to demand. And that implies that if we are to reach the 1.5 degrees trajectory, if we bring about again this surge in clean energy investment to bring about reductions in fossil fuel demand, that some of those higher cost projects would need to be shut in. Around about 7 million barrels per day of oil demand would be surplus to requirements, and close to 600 billion cubic meters of natural gas in aggregate would be surplus to requirements. As things continue to develop, we'll of course continue to update our scenarios, but this is a worrying sign that we are not yet on track for 1.5 degrees and that much more needs to be done. Thank you,
Christophe. So we're really getting a lot of questions, which is excellent, but also a challenge for me. So I'm going to cram as many of them as I can in for our colleagues to answer. One is from Jack Dutton from Al Monitor. He's asking, what can the state-run oil companies in the Middle East be doing more of to meet climate targets? The Aramcos and the ADNOCs of this world, especially in light of the CEO of ADNOC holding the COP28 presidency this year. What steps must they take to help the industry meet the Paris goals, and how can they use their influential position to spark meaningful change in the fossil fuel sector? So there's that question. And then there are a couple of questions around collaboration, which is an important finding from the report. One from Polita Clark from the Financial Times. You say collaboration is essential to give producers a stake in the clean energy economy. What is a concrete example of what that collaboration should look like? And is there any meaningful example of it happening today? Similarly, Terje Erikstad from Norway, from DN in Norway, asks, how can producer and consumer countries cooperate in practice to reduce supply and demand for oil and gas, sorry, that's from the Norwegian Business Daily, and in that theme, Stanley Reed from the New York Times is asking, it seems like such a diverse group of companies is unlikely to act in a unified way. Isn't the most important thing for governments, consumers to provide rules and incentives to accelerate the energy transition? So it's quite a big bundle of questions that I'm going to pass over gently to our Chief Energy Economist, Tim Gould, I think to at least address as much of that as he can. There's a few interlinked elements there that hopefully Tim can have a go at. Over to you.
Thanks very much, Jethro, and thanks very much for the questions. So at the start of the presentation, I tried to make the point that there are some really big players in the oil and gas space, the national oil companies, and that can play, in our view, a very important role going forward. And as is highlighted in the question, the UAE, where ADNOC is based, is going to be hosting the COP28. So I think it's a legitimate expectation that these companies could and should be doing more. I think it's first of all to have in mind that there's a very broad range of national oil companies out there with different strengths and different financial means and different circumstances. But companies like Saudi Aramco or ADNOC, they have a very important leadership role there. They can really set the tone for what is possible, what's on the agenda, and then brings us back to some of the issues that the executive director mentioned in his opening remarks. A sort of non-negotiable element in this is the dealing with companies' own emissions. And I think it's a legitimate expectation that on that issue we should see some significant move forward at COP28, because the UAE has the ability to mobilize a broader coalition of companies to engage in a meaningful way with clean energy transitions and the Paris Agreement. But as we've also made clear in the presentation, our ask of the industry goes beyond that. And so that brings us also then to the incentives, the collaborations that can take place more broadly across the clean energy space. Now, some of that is also related to methane. It would help, for example, if big importing countries attached value to demonstrably lower emission sources of oil and gas. That would help to incentivize the measurement, the emissions abatement opportunities that we see. There is also good examples, I think, of collaborations that could take place in setting up new clean energy value chains. It will be important, for example, for importing countries, but demand sectors in general, to provide an anchor for new production of low emissions fuels. In the most recent hydrogen review that the International Energy Agency released a few months ago, we made it clear that there's many more projects out there to supply hydrogen than there are to use it. So if we can anchor demand, that will provide strong incentives for then producers to move into some of these new areas. And we also see plenty of opportunities for technology collaboration, because it is true that also in the Middle East we see some promising pilot projects, demonstration projects, but also real industrial projects that deploy clean energy technologies in some emissions intensive sectors. So much more momentum in that area would also be extremely helpful. And those are the sorts of areas where we see a lot of potential for governments to work together. And I come back to something that Christoph said. There is, in our view, a slightly unproductive debate about whether demand needs to lead or supply could be moving first. In practice, when you look at this in detail, you see that any rapid transition will require a coordinated move across different sectors, so that when a company decides to move its ships onto a low emissions fuel, you also have the infrastructure in place and you have the providers of those low emissions fuels moving in parallel, so that that is a coordinated move towards a different kind of energy system.
Thank you very much, Tim. So we're going to try and squeeze in just a couple more questions. One is coming back to the carbon capture issue. Why is the IEA so negative on the prospects for carbon capture, utilization and storage to address oil and gas emissions? And then another one on referring to COP28 from Agence France-Presse. What are your expectations for governments that own national oil companies during COP28? So I think our executive director will take these two last questions, Dr. Birol.
Okay, with pleasure. By the way, these launches are very good for me. Just I learn a lot from my colleagues from both from Tim and Christoph this time. Many thanks to them as well. Now, dear colleagues, IEA is not negative about carbon capture and storage. In fact, it's a technology that we have been saying since 20 years needs to play an important role to address our climate change problem since 20 years. But when I look at the last 20 years, what happened in the carbon capture and storage evolution, it is a story of disappointment. To be frank with you, we have seen very little move. We are now seeing a bit in Europe, in Norway, for example, in Canada, United States, maybe China coming through, and some Middle East countries. But what we are saying is this is good, and CCUS can be also very important, we believe, in the context of the industry sector reducing their emissions. It can be cement, it can be iron, steel, and others. But what are we warning everybody about is the following. The several people say that we can continue with our fossil fuel trends as we have now. We will invest, we will bring them higher, we will consume them as we are doing now. And with CCS, we can at the same time fulfill our obligations to reach our climate goals. This is impossible. It doesn't work. The numbers don't work at all. As I tried to mention a few minutes ago, in order to, with the current trends we have in the oil and gas in terms of production and consumption, and at the same time, if we want to keep our climate goals alive, we have to each year invest on this CCUS technology about $3.5 trillion. This is about 1,000 times higher than what we are doing today. So therefore, we want to underline this so that we don't have false hopes from a technology, and at the same time, we don't want to give this CCS as an excuse to some in order to continue by what they do, continue to do what they have been doing in the past along the same line. So this is the reason why we come up. And from our point of view, reducing fossil fuel emissions mean reducing fossil fuel use. This is so clear, and we think there is no way around that. This is the first attempt to answer the CCUS question. So what do we expect from oil and gas industry in COP28? So we would like to see they are the partners to address climate change together. Oil and gas industry, they have a lot of skills, experience, deep pockets. They can well be part of our efforts to address climate change. There are many technologies which have affinity with the clean energy technologies, what they are working on. Our numbers show that 1/3 of the clean energy technologies we need to reach our climate goals overlap with the skills, experience of the oil and gas industry. Them being on board will make us, the world's reaching climate targets, much less difficult, I should say. It's already a difficult task, but we need them. It is the reason we made this report. It is an invitation to the oil and gas industry to work with the rest of the world, to help the world to bring us in a better shape fighting against climate change. This is what we would like to see. And I know that the COP28 president, Dr. Sultan Al-Jabbar, he is talking with several oil and gas companies, executives around the world to bring them and to make some commitments. And there is a work going on there. We, as International Energy Agency, we will be very happy to see a commitment from the oil and gas industry, which is in line with what we have been today outlining, and therefore we will be very happy to endorse those commitments and congratulate the oil and gas industry. We want them to be the part of our fight against climate change.
Thank you very much, Dr. Birol. I think that's a good place to end, and it is indeed all we have time for. We've actually gone over time to answer as many of the questions as we could. If any journalists have questions that didn't get answered during the Q&A that you'd like to follow up on, we invite you to reach out to our press office. The email is press@iea.org, and we'll get back to you as soon as we can. So thank you very much to Dr. Birol, to Mr. Gould, to Dr. McGlade. Thank you to the journalists for the great questions, and to everyone following along online. Do go take a look at our website and read the Oil and Gas Industry and Net Zero Transitions report in full, available for free on the website. There's lots to explore. Do take a look, and we'll leave it there. Thank you and goodbye.